Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making them move, and what we expect to happen here in the near future. Today is Wednesday, March the 8th, 2023. It is now 4:15 p.m. Central Time, and the bond market and mortgage security market are closed for the day. So let's take a look. We know it's been very volatile the last few weeks. Let's see where we are right now. We pull up our charts that we look at each day, and we see here that our mortgage-backed security is currently down 14 basis points, and the 10-year Treasury is up to just banging up against that 4.0 psychological ceiling that we've been talking about for, a year now. And with the mortgage-backed security down 14, you can see that it was down quite a bit here today at different times throughout the day. As we scroll down, we take a look at our inverse chart. Again, if you're newer to this channel, understand that when this goes down, home loan interest rates go up. And for the past month, you've seen a big drop here after an employment number. So a jobs number that came out February 3rd of this year. And interest rates have really just gotten worse day after day after day, ending about 1% higher than they were. We were talking about 5.875 this day here, and now we've been more recently talking about 6.875. We're going to take a look and see where we are here in just a moment. Now, a couple of things here on the technicals that I want to point out. First of all, you can see that we banged off of this floor of support, going up here, jostling. That's a big range that we went through today, right? And that goes to show you that the market is just not sure what we are going to be receiving on our big jobs report that is coming out. The BLS jobs report, the Bureau of Labor Statistics job report that is coming out this Friday, March the 10th, that will give us the job numbers from February, is going to be key. And I've got people saying we're going to have a great report. I've got people saying we're going to have a terrible report. With all of the, I don't want to say manipulation out loud, but, that's kind of the word maybe that we need to use, that we saw in last month's numbers. It leaves us wondering, doesn't it, what we're going to get, because it just doesn't seem to make sense. But one other thing down here on the stochastic charts here, we see that when the last time that we were hitting our peak, this is what's called an overbought position. We'll talk about that again someday. But right now we are in a highly oversold position. So we are ripe for purchases on the mortgage-backed securities. So we really do have a lot of reason to believe we should have a turnaround here, but it's all going to depend on the report that we receive on Friday. So I think we're going to bounce around a little bit. We did not get a lot of good news today in the news because Jerome Powell was speaking, and he was really talking tough, saying, "Hey, we are not going to stop until home loan interest or until inflation is under control, and we are going to get even more aggressive on our moves with the federal funds rate if we don't see some reports coming out soon that are showing some positive effects in reducing inflation." Well, it's hard to do that when the numbers aren't coming out the way they're supposed to. When there's not any type of manipulation or alteration to where we're not even comparing apples to apples at sometimes. So we're going to have to look further into that here. Something that I did see, a report that came out today talking about that the huge amount of job creations that we saw in February, on February 3rd for the November timeframe, that November timeframe, which was just literally millions away from what we expected. So it was a huge difference. And that there was some news out there that there was a large amount of jobs were dumped into that report from illegal aliens that had come over during the past couple of years, and that those were now being counted in the employment numbers. Just again, a different calculation. So people that weren't being calculated are now being calculated, and it throws the numbers off. The other thing is that they have something that is called seasonal adjustments. So they go in and they say, well, there weren't as many jobs, or there was a lot of job losses, but we know those were part-time jobs because of holiday hiring. But when the holiday hiring was happening, they were showing those as job improvements. They were showing those as hirings. So now they go back and go, well, yeah, a lot of those people lost their jobs, but those were just seasonal anyway. So again, that's where, these numbers can be skewed, and we really have to look closely at them. But at the end of the day, what you really want to know is, what does that do to our home loan interest rates? So let's take a look and see where we are. We're going to run our Brent Bruce Daily, which is our very well qualified 30-year fixed conventional home loan for a very well qualified client with 800 FICO scores, 25% down on a primary residence, single family residence home. So let's take a look. So again, these are the real rates. And as I talk about, I run this with multiple banks. The bank at the top is usually, in general, priced the best. Now, again, this can change day to day because the computer does the work for us. But right now, 11 Mortgage is pricing the best on our scenario, 6.875 with a little bit of a credit, $486. Now, if you watch the Brent Bruce Daily every day, which you should, you know that we were talking about 6.875% having a credit. I think it was $7 like 2 days ago. So we have seen a little bit of improvement to the cost of getting a 6.875% interest rate because the credit is larger, but yet we haven't seen any improvement in the mortgage-backed security market. So what you've been seeing the last few days as you are learning how to understand how home loan interest rates work is that the mortgage-backed security market is a part of it. And what the banks price their business out is the second part of it. When I say banks, I'm not talking about necessarily the major banks, the Chases and the Wells and all that kind of stuff. I'm talking about the mortgage banks. So the mortgage banks can adjust their margins. So they can say, hey, I want to make, right now things are good, so I'm going to make this much money. And then they say, well, I still want to be competitive, so I'm okay making this much money. Or, hey, I want to run the table. I want to have the lowest rate in town, so I'm going to make this much money. So they can mess with their margins according to what is happening. So in this case here, for whatever reason, 11 Mortgage is pricing the best. So how are they pricing the same day after day when we're seeing mortgage-backed securities getting worse? Because they're shrinking their margins in order to stay competitive. And as we talked about a few days ago, in order to not be at 7.0. 7.0 is a psychological number that we do not want to be at. That a lot of people will just say, yeah, 7, I'm out. I want nothing to do with it. So we don't want to see 7, especially if you got 7 on your bank and 5 other banks have 6.875, you're gone. So it becomes a very important number, and they're going to hold on to it, and they're going to shrink their margins as skinny as they can to try to keep to being able to hold on to being in the 6% interest rate in the game. They're not in the game. If you're dealing with people that are saying 7 and 7.25 on very well qualified 30-year fixed conventional loans, they're not in the game. Call someone else, because that is not what they should be charging. Their margins are too big. Okay, they're making too much money. Maybe they have overhead. I don't know what their net margin is, but they're spending too much money somewhere, or they're making too much money. So let's take a look and see again where we are at. One more time here. If we look at a couple of the other banks, United, when you see expired, that means that they're making adjustments to their rates. They adjust throughout the day, guys. They do intraday reprices throughout the day. I think there was 2 or 3 intraday reprices today. So you really have to pay attention to what is happening. So while we finish this up here, just remember that Friday the 10th is a big day. We may see a rally in mortgage-backed securities. We may see interest rates come crashing lower, and we'll all celebrate that time. But we also might see a report come out that says that jobs are great. Now, again, this is one of those reports I always want to make sure you know. We'll talk a little bit more about that during the week. But we, as mortgage people, as whatever, real estate people, if you want home loan interest rates to improve, you want a bad jobs report. You do not want to show, if everybody is having a cheer and yelling, jobs are great, the market is great, our economy is great, everything is booming, that's inflationary. That is inflationary. If all of a sudden people are losing their jobs, what do they have less of? They have less of money. If they have less money, they can buy less product. If they buy less product, that creates less demand. If there's less demand, that leaves more inventory. You understand? So you need to pay attention to how all of this works. If we have a great employment number, home loan interest rates are not going to like that because that is inflationary. We'll talk more about that, longer video, but a lot going on. And because of the way things are right now, you need to really understand how this all works. Let me know your thoughts. Make sure that you like, subscribe, and share. And just, if you have any questions, reach out to me. I have answered every question or comment that has come over in the past year. So make sure that you do go ahead and reach out. Let me know if you have any questions. I will talk to you again soon. Have a great day. See you tomorrow.